I see a few more people are still joining. We have about 57 people or 58 now. So that's very good. But I'd like to welcome everybody this morning. For those of you who don't know me, my name is Dave Ernest, and I am the co-chair of the Louisiana Bar Foundation's Grantee Audit and Training Committee. So over the next 2 mornings, the Louisiana Bar Foundation is conducting its annual grantee training. Today, we will cover the topic of audits, and tomorrow we'll cover the subject of board governance. A few housekeeping matters before we begin. In the Zoom meeting, we have our moderator and host, Renee LaBeouf, with the Louisiana Bar Foundation, and she will mute everybody for the purposes of the meeting, of the presentation. At the end of the presentation, we're going to have a question and answer session. You can either type your questions in on the chat room, or you can raise your hand, and Renee will call on you and allow you to ask your question. So now what I'd like to do is I'd like to introduce our speaker. This is a new subject that we have added this year that we have not covered in the past. And I'm honored to have with us Michelle Cunningham as our presenter. Michelle graduated from Louisiana State University with a bachelor's degree in accounting and earned her CPA certificate 2 years after graduation. She has over 39 years of experience in public accounting. She is a member of the American Institute of Public Accountants, the Society of Louisiana Certified Public Accountants, and the AICPA Audit Quality Centers. She has earned the AICPA Certificate of Educational Achievement in Governmental Accounting and Auditing. She's a senior partner in the accounting firm of DePlanche, Ratman, Hogan, and Mayer CPAs, and she oversees the audit practice at the firm. She has been involved in auditing nonprofit, for-profit, and governmental entities her entire career. She currently audits the Acadiana Legal Service Corporation. She has audited parishes, cities, state agencies, local entities, public retirement systems, and numerous types of nonprofit entities. She has assisted in governmental entities in conjunction with the Louisiana Legislative Auditor in the implementation of accounting standards, in addition to providing continuing education on accounting standards. She has also provided financial accounting education to various organizations at their annual conventions. Throughout her career, she has assisted her clients in strengthening their internal controls, in addition to implementation of general ledger systems. She has 4 grown children, 7 grandchildren, and a wonderful husband who keeps her grounded. So please join me in welcoming Michelle. Thank you, Michelle.
Thank you very much, Dave. And thank you for inviting me to be here today with you guys. I am going to share my screen. Okay, so does everybody see the presentation? Okay, I'm assuming that's a yes. So thank you for inviting me here today to talk about financial audits. What is this, and then some. So we're going to go over exactly what is a financial statement audit. What are you getting when you...
I'm sorry to bother you. We don't see it.
We don't see the presentation.
Okay, let's see.
Michelle,
I got to hit the button share. I guess that would help. All right, do y'all see it now?
Yes.
Okay, sorry about that. Technology is not my strong suit. So anyway, we'll kind of go over financial statements audits. What are they? What exactly you're getting when you engage a CPA firm to perform your financial audit? And then we'll also go over a couple other things that I thought maybe would be of interest to you guys. So we'll start off with financial audits. What exactly is a financial audit? You know, what are some of the responsibilities of management? What are the responsibility of the auditor? What is the auditor actually looking for when they do the financial audit? Then we'll go over some audit committees. What is an audit committee? What are some of the responsibilities of an audit committee? Then reporting requirements. Depending on the type of funding that you receive, you may have some reporting requirements to the federal government and or the state government. And then safeguarding of your assets. That's really an important thing that entities really need to take serious is safeguarding of your assets. So what are some of the ways in which you can safeguard your assets or strengthen some of the controls you have presently have over your assets? And then we'll end up with credit cards. It's kind of been the hot topic lately, is credit cards, and how do you make sure that abuse of credit card doesn't happen, or any kind of fraud occurs with your credit cards. So I found this by a guy by the name of Sidney Harris. I thought it was very interesting, and hopefully I can do a little bit of both of these for you guys. Informing and communicating, you know, these two words are used interchangeably, but they are quite different. Informing is giving out and communicating is understanding. So hopefully today I can inform you and give you some information that when you walk away, you kind of have a little bit better understanding of financial audits. So first, getting started, financials, I want to kind of go over financial statement services with you that a CPA firm does provide. You know, that term audit gets thrown around very loosely, and it is significantly different than other types of services. So a lot of times people say, oh, we need to get an audit done. Well, in actuality, it may be a compilation that gets done or a review. So I kind of wanted to give you just a basic understanding of the different types of services that CPA firms can provide to entities. And this may help you understand when that term audit gets thrown around, maybe really what they're not looking for is a financial audit. They may be looking for something else. So the first type of service is it's really a basic financial statement preparation. It's performed in conjunction with bookkeeping or transaction processing services. It can be performed monthly, quarterly, annually. It's just pretty much the CPA or bookkeeper goes in, records the transactions, and then prepares financial statements. There is no assurances provided to this, and it's typically used for the entity's internal use only. Compilation is the next service. This is where a CPA will come in, they compile the financial statements from the information that's provided by the entity. So the CPA will take the general ledger and just prepare those financial statements, prepare the balance sheet, and prepare the income statement. They look at those financial statements just to make sure that they seem reasonable, that the financial statements make sense. The CPA will issue a report, but there are no assurances is provided on the financial statements. Typically, you'll see compilations are required for lenders or outside parties. I've seen it where contractors may need a compilation performed that's for them to get licenses. So, or a lender, if you have a line of credit, they may require a compilation. But there are no assurances. It's just a matter of pulling together the data in financial statement format. The next level is a review. This is typically requested by lenders or outside parties. There is some level of assurance provided on a review. A review typically includes the financial statements, and then it will also include footnotes. The CPA will issue a report, and the CPA in the report will say, you know, there is some limited assurances on these financial statements and footnotes. You'll typically see this for lenders will require it. You know, if you have maybe a larger line of credit or a bank loan out there, the bank may want a review. Then the last is an audit. That is what we're going to be talking about today. This is the highest level of assurance that you can obtain. So an audit is the top level of actually testing and assurances that can be provided on those financial statements. So why do entities obtain an audit? You know, the biggest reason is to meet a regulatory requirement. As I mentioned earlier, some banks may require a compilation or review, but then they may also require an audit done depending on the type of financing that bank is providing. Maybe a grantor will require it, or a donor. You've received a lot of money from a donor and they want to see the audited financial statements. So the grant may require financial statements. They want to see that the money is being spent in accordance with the grant, you know, to also ensure compliance with laws and regulations that have a direct and material effect on the financial statement is another reason any entities obtain an audit. Fundraising, that's a tool that some entities may use in order to have donors donate to you guys. You can then, show your financial statements and prove and reflect that you're using the funds for the programs. So it's a good tool sometimes for fundraising. Also, it could be from your bylaws require an audit. You want to ensure that the assets or the items owned by the entity are owed to the entity, and the liabilities, the items that are owed by the entity exist, and they're fully recorded and disclosed in accordance with generally accepted accounting principles. And that term, generally accepted accounting principles, I'm going to talk about that throughout the presentation. GAAP is the accounting principles that everybody follows. It is the laws, or I guess the rules that is determined on how an entity records transactions and presents them on their financial statements. And so if your financial statements are in accordance with GAAP, in accordance with these regulations, then you'll say that in the independent auditor's report. To ensure all revenues and expenses are properly recorded in accordance with GAAP. And then also to ensure that all your note disclosures or in your financial statements meet GAAP. So these are all different reasons why entities obtain audits. So an audit of the entity's financial statements includes your basic financial statements and footnotes. And the primary purpose, and I have this kind of in red because I wanted to, emphasize this. The primary purpose of a financial statement audit is to provide an opinion about whether the entity's financial statements are presented in accordance with generally accepted accounting principles. So, are they presented in accordance with all these rules that are set up by the accounting standards? Is income presented the way it should be? Is it disclosed in the footnotes the way it should be? The same with your balance sheet. And the audit, the financial statements that are typically audited are a full set of financial statements are the balance sheet, income statement, and cash flow. Your balance sheet represents your total assets and liabilities at a point in time. So it's if you took a snapshot, and let's use December 31st as your year end. It's as if you took a snapshot at December 31st and said, what are my assets and what are my liabilities at that point in time? On your income statement, it's the revenues that you received over time. So over that 1 year period, what revenues did I receive and earned, and what expenses did I incur over that period of time? And then your cash flow statement is another required statement. And this statement reflects where am I receiving my cash and where am I spending my cash. So there's certain categories that gets reported. One is cash flows from operations. So from my operating activities, where did I receive cash and where did I spend my cash from my operating activities? Another category is your financing activity. That is where you typically will see money's coming in from any kind of loans or lines of credit, and then the payment off of those loans and lines of credit. So did I receive any money from financing activities, or did I spend money in my financing activities to pay off those loans? Another category that's not listed here is investing. So where did I receive money from any investments that I own? Any kind of dividends did I receive, or interest did I receive, or even purchases and sales of those funds? Where did I purchase investments? How much money did I use to purchase an investment? And then if I sell an investment, what monies did I receive? And so the cash flow statement kind of just lets the reader know for this entity where are they spending and receiving cash in the various categories. So an audit will encompass the balance sheet, the income statement, the cash flow, and the footnotes, because the standards require specific things to be disclosed to provide the reader with more information about the entity and about the financial information. And that's all covered and included in the footnotes, all of which gets included in the audit. So what exactly is the auditor looking for when they audit your financial statements? You know, these are the 5 categories that they focus on when auditing financial statements. You know, overall, the auditor wants to make sure that the financial statements are materially stated, that there's some reliability of those financial statements, and the audit is determining the reliability of the underlying information that's used to prepare those financial statements. So, and also something else I kind of wanted to bring up that's, you know, also down kind of at the bottom of the screen is when the auditor is auditing the financial statement, the audit is not intended to find fraud. They don't specifically look for fraud. So, you know, I know a lot of times what happens is if there's fraud discovered, the first thing they do is they look to the auditor and say, well, why didn't you catch this? You know, you can prepare and perform an audit. An audit can do that and not find fraud, and they're still within the standards. We're going to talk a little bit more about fraud on the next slide, because it doesn't mean the auditor has no responsibilities over fraud. It's just not the main focus. The main focus is to ensure that the financial statements are materially stated, that the underlying information that creates those financial statements is reliable. So the 5 areas that auditors will look at is completeness. So is anything missing out of those financial statements? Is all the revenue captured? Is all the expenses captured? You know, is all the cash reported? Is all the assets and the liabilities reported on the financial statement? Is everything included on those financial statements? Are they complete? The other thing is existence or occurrence. Did they have it, and did it really happen? You know, did that revenue actually occur? Or are they overinflating revenue? Are they underinflating revenue? Did the actual occurrence happen? Did that transaction occur? Accuracy and valuation. Are the numbers correct? You know, the auditors will make sure that what's reported is correct. They'll look at the underlying data. They'll go out to third parties to make sure that the numbers are correct, and those third parties can confirm that that information is correct. And valuation, you know, that's really a key thing that auditors look at is, are the assets valued correctly? Are your liabilities valued correctly? And in some situations, it's pretty easy, you know, to determine if that value is correct. You know, cash, you can go back to a bank statement. So that's pretty easy to determine the valuation. But then you can have other items such as investments. You know, some investments are very easy to value. They are traded on a particular market, a market that actively trades these investments every day. So at the end of December 31st, you can determine based on that market if that asset is valued correctly, specifically stocks and bonds. But then you could have an investment that's a lot more complicated. You could have a derivative investment where the valuation is determined by future cash flows. It could be determined by appraisals. So it can get a lot more complicated on the valuation of a particular account. And the auditor needs to make sure that that valuation is materially stated. Rights and obligations. Do they own or owe what they think they do? You know, do they have a right to that asset? Do they owe anybody what they think they owe? Are the liabilities reported correctly? So rights and obligation is something else that we would look at to ensure that it is correct. Presentation and disclosure. Is it in the right place? You know, is your revenue reported correctly? Is it in the right place? Is your expenses recorded in the right place? I mean, you could have revenue that you received that you technically didn't earn. So it shouldn't be recorded on your income statement. It really should be recorded on your balance sheet. Leases is a new item that came up probably the last year. In the past, your lease expense, if you have an operating lease for your building that you perform your operations, and you lease that building. In the past, it would show up as an expense. Well, recently the standards changed and said, well, no, then we want to put that on your balance sheet. We want to show a right of use asset and a lease liability. And so is that lease transaction recorded in the right place? Is it disclosed? Is the information that's required to be disclosed in the footnote, is all of that included that should be included in the footnotes? So all of this is the type of information and the type of things that the auditor will look at to ensure that your financial statements are reliable. So financial statement auditor responsibilities, an audit is defined as the collection and evaluation of evidence to support the opinion, the reliability of the financial statements, as I mentioned earlier. We want to make sure as your auditor that the evidence that is supported, the evaluation of the evidence that supports your opinion, the underlying data. So as our responsibility, or your auditor's responsibility in doing this audit process, is to obtain reasonable assurance that the financial statements are free from material misstatements, whether due to fraud or error. So reasonable assurance, your auditor cannot get up there and say, your financial statements are 100% accurate. We just don't provide that type of assurance. Reasonable assurance. And reasonable assurance is a high level of assurance. It's just not a guarantee that an audit conducted in accordance with the standards will always detect a risk of a material misstatement. Risk of a material misstatement from fraud, is a higher risk. It could involve collusion. It could involve forgery. It could involve misrepresentations. So that's why that reasonable assurance is provided. The auditor is required to exercise professional judgment, maintain professional skepticism. When the client would provide the auditor with information, the auditor needs to make sure that there's collaborating evidence to support what the entity is telling them. The auditor also has to identify and assess the risk of a material misstatement in the financial statements. So they'll look to see, okay, let me get an understanding of the entity. Let me see how they process transactions. What are the internal controls? And then based on the understanding of the entity, based on the understanding of the controls, where could a risk of a material misstatement occur? And that's where the auditor is going to focus. So, for example, if an auditor is auditing IBM, IBM has significant controls in place, and they operate in a much different environment than, say, the mom and pop grocery store down the street. So those audits will be completely different. Although you're following the same standards, the entity is different. The risk of material misstatements are going to be different between the two. So it's the auditor's responsibility to really get to understand that entity, the environment that entity operates in, and what are the internal controls, and then determine what is the best way to approach auditing so that the risk of a material misstatement is minimized. And the auditor can then provide an opinion on the materiality of those financial statements. The auditor also has to evaluate accounting policies and management's estimates. There's estimates throughout financial statements. That's where that valuation comes into play. Some of those estimates are very complicated. Some are pretty simple. For example, depreciation. Depreciation is a pretty simple estimate. It is an estimate on the use of that fixed asset over time. So the auditor is going to look at that estimate and make sure that it seems reasonable, that the entity is not using, say, 15 years to depreciate a computer. Everybody knows a computer is not going to last for 15 years. So they'll look to make sure that those estimates are reasonable. Other estimates, a little bit more complicated, as I mentioned earlier, those derivative investments, those estimates can be a lot more complicated. but it is the auditor's responsibility to make sure that those estimates are reasonable and they're materially stated. Also, the auditor is required to conclude whether the entity will continue operating for a reasonable period of time. So does the auditor think or believe, based on the auditing that they have done and based on reviewing the financial data and the operating entity and the environment operates, will it continue for a reasonable period of time subsequent to the issuance of the financial statements? And then communicate with those charged with governance. And those charged with governance could be management or it could be a board. You know, and there is required communication that the auditor should provide to those charged with governance. You know, you typically will see that at the beginning of the audit, just letting everybody know the timing of the audit, also what the auditor thinks the risk of a material misstatement is. And then at the end, there is some required communication that the auditor does provide on any findings that occurred, any adjustments that needed to be made, were there any issues in performing the audit? All of that is some required communication under the auditor's responsibilities. And interestingly enough, a few years ago, the auditing standards changed and required that all of these responsibilities be included in the auditor's report. So now it is pretty, you know, they wanted to make sure that it is very clear and very transparent what are the auditor's responsibilities. And then management does have responsibilities in the audit. You know, its management is responsibility to prepare the financial statements in accordance with that generally accepted accounting principles. Now, keep in mind, you know, these are the standards across the board for everybody. You know, and sometimes you have a smaller agency or entity that maybe doesn't have the capability of preparing the financial statements in accordance with generally accepted accounting principles. You typically will see the auditor assist in that preparation, and then management would review those financial statements to make sure that the financial statements are presented in accordance with GAAP. Also, management is responsible for the design and implementation and maintenance of internal controls over the preparation of the financial statements. So, you know, the internal controls or just the procedures in which they prepare the financial statements. So it's management's responsibility to design and implement those procedures. Safeguarding of the entity's assets, and also management is responsible to conclude whether the entity will continue operating 1 year after the financial statements are issued. Now on to audit committees. So an audit committee is typically a subset of a board. The responsibilities of an audit committee is really to oversee the financial reporting process and disclosures. They typically hire the independent audit firm. They will monitor accounting policies. They're kind of an advisory committee to the board. They'll also meet with the audit firm. They would meet, sometimes I've seen where audit committees meet with the audit firm before the audit starts, and then also after the audit has completed. They'll go over the audit with the audit firm. And this process, you know, typically will have members have some kind of financial background. So they kind of have a deeper understanding of the finances of the entity. And they can then really go in depth in the audit report. And then the audit committee will then communicate with the board if the audit firm doesn't present to the board. So it's really more of an oversight of the whole audit process and some of the finances of the entity. Not everybody has audit committees. Smaller entities, I haven't seen a lot of audit committees, but if you are a public company, you are required to have an audit committee. And some of the advantages of an audit committee is that it's a smaller group, and as I mentioned, it's typically those that have some kind of financial background. And so when the financial information is presented, they can provide a lot of input into that financial information and then just provide an overview to the board. Next is on reporting requirements. So, as an entity, sometimes you may receive federal funds or you may receive state funding. And depending what you receive, whether it's federal or state funding, there is some requirements of reporting. So on the federal government side, if you receive federal funds greater than $750,000, an audit is required, and it's required to be submitted to the Federal Audit Clearinghouse 90 days after year end or 30 days after the audit is completed, whatever is earlier. And then you also must comply with the uniform guidance. So it's just additional standards and testing on compliance with the grant. So typically you'll see if you receive federal funds, then a single audit must be done. Keep in mind, this $750,000 is not necessarily going to be received directly from the federal government. A lot of times federal funds are passed through the state of Louisiana. So you need to look at the funding that you receive, not only directly from the federal government, but federal funds that are passed through the state, because all of that gets combined into this $750,000. So if you do receive monies coming from the state, you may have to determine, is it federal funds or is it state funding? And then on the state side, if you receive any kind of government funds, whether it's federal funds, state funds, or local funds, if you receive $75,000 and under, then sworn financial statements are required to be remitted to the Louisiana Legislative Auditor. If you receive $75,001 to $199,999, a compilation is required and to be remitted to Louisiana Legislative Auditor. And if you receive $200,000 to just under $500,000, a review is required to be remitted. And if you receive $500,000 and over, an audit is required to be remitted to the Louisiana Legislative Auditor. So keep that in mind. If you receive any kind of governmental funds, whether it's federal, state, or local, there is some reporting requirement that has to be met, or could potentially have to be met. This next section is safeguarding of your assets. Your assets are valuable resources. They contribute to the overall success and stability of a business. And your assets could include your physical assets, such as cash, equipment, and property, but it's also intangible assets, intellectual property, consumer data. It also encompasses protecting sensitive information. And to safeguard your asset, it requires two types of internal controls or your policies and procedures. You need to make sure that your internal controls another term is policies and procedures, have specific controls in place. You want to make sure that it has prevention controls and detection controls. So effective internal controls is making sure that you have accounting policies and procedures. And your basic accounting policies and procedures would include cash receipts, cash disbursements, payroll, and financial statement closing. You could have more policies and procedures if you have more items, such as if you have investments or debt. So you may want to have some more policies and procedures over your investment processes and your debt, maybe even cash management. But these are some of the basic policies and procedures that you really should have, or every entity should have. So the prevention controls, your prevention controls are proactive. They focus on quality. So you want to make sure you have these specific controls because they prevent errors occurring. They could prevent fraud from occurring. So the first thing is segregation of duties. That is really a key thing. You don't want to have one person have complete control over the asset's life cycle. You want to make sure that you have different people touching the transaction as it goes down the line and gets processed. So you want somebody different initiating the transaction, from recording the transaction to reconciling the accounts. That way you have different people looking over this transaction. Job rotation. You don't want, if someone goes on vacation, which everybody should be taking vacation, you want someone when they leave to someone else to step in and do that job. That way, somebody else has a different eye on what is occurring over that, so that if anything is hidden, that can be revealed by somebody else taking over that position. Authorization and approval of invoices. You want to make sure that an invoice is authorized. I want to make sure that somebody who may be receiving the item documents, yes, I received it, then gives it to someone who approves the invoice for payment. Access control. Limit your access to your general ledger. Require passwords. Require passwords and make sure passwords aren't, readily known by everybody. You want to make sure that you limit access so that somebody who may be doing payroll can't access the general ledger, or someone who's doing accounts payable doesn't access payroll. Have all that separated, and so they can only access what their area that they are responsible for. Verification by a second party for electronic payments. Have two people have to approve electronic payments. Physical security measures. A firewall. I mean, that's been huge with data, to keep your data safe. Encryption, and just a plain old lock. Lock up any kind of inventory that you want to safeguard. Checks. If you have blank checks, you want to make sure those blank checks are locked up. If you have a signature stamp, which as auditors, we're not big fans of signature stamps, because anybody who gets hold of the signature stamp, they now have signature authority over your checking account. But if you absolutely have to have it, make sure that signature stamp is locked, and it is limited to certain people, and only certain people can access that lock. You limit your cash accounts in one bank account to the FDIC insurance limit of $250,000. And keep in mind, if you have 4 cash accounts, that all 4 cash in one bank, all 4 cash accounts must be under that $250,000. And employee training. That is another huge thing. Train employees on these policies and procedures, make them aware of these policies and procedures, and make them aware that these need to be complied with, and to ensure that you're safeguarding of all these assets. And IT training regarding email, phishing emails and malware emails. There's so many stories I hear where an employee receives an email from somebody who thought it looks exactly like it's coming from them, and they request that their bank account gets changed. And it gets changed, and come to find out it was a phishing email, and now the money's going to the wrong person. So IT training on how to recognize phishing emails. And then also, if you do get an email like that, pick up the phone and call and just verify, yes, the account number should change. So now the other thing is, you've got your prevention controls in place. So you're looking to make sure that you're preventing some errors from occurring. What happens if they do slip through? So then you have these detection controls. These are the ones that find errors after they occur. They design to find problems afterwards. One is review of paid invoices and payroll reports and general ledger transactions. So review those paid invoices. Make sure that the paid invoices agree to the check. Your payroll reports. Review those payroll reports. Look to see that everybody on the payroll report is an employee. And are they getting paid the correct amount? I mean, you probably know what your employees should be paid. Review those payroll reports. Your general ledger transactions. Review your general ledger. make sure that the transactions are within line of what you anticipated they should be. Monthly bank reconciliations of bank statements. And I can't stress this enough, that the bank reconciliations be done on a monthly basis. I mean, I had a client one time who was behind on their bank reconciliations, and they were behind a number of months. And they did not detect that one of their checks was stolen, whitewashed, and was cashed for a significant higher number than it was originally written for. And when they eventually found it doing their bank recs, the bank told them they were too late for any kind of recourse. So make sure that you do this on a timely basis. Prepare yearly budgets and review the budget to actual financial statements. That's going to let you know if your expenses are falling in line and your revenues are falling in line, if what you think, you anticipated your revenue and expenses were going to be. And sometimes, things don't always work out. You may have some big repair that occurred, and so you're going to be over budget, but at least there is some explanation. So reviewing budget to actual financial statements is a good detective control. And then physical inventory. Go out and physically count your cash if you have cash drawers, or inventory. Physically count your inventory and make sure that what you're physically counting as inventory, it ties back to what is being reported on your general ledger. Your fixed assets, your computers and your desk. I mean, your desk really isn't going to walk away, but computers could walk away. Do a physical inventory of those types of items, and that would catch if anything has been in error on your financial statements. And the last thing is credit cards. I'm sure people have seen in the news recently what the poor town of Abita went through with their credit cards and the theft that occurs. Credit cards is a hot topic right now. It was a number of years ago also a hot topic. If anybody is going to get in the news, it's always going to be, not always, but a good portion of the time, it's credit cards. And so you definitely don't want Lee Zurich knocking on your door and saying, okay, can I have these records because I've heard about this credit card abuse. So hope to prevent that, have good safeguards and good policies and procedures. Develop those strong policies and procedures. And some of the things that should be included in that is how cards are controlled. What is an allowable business use? Document what you can and cannot use for that credit card. Documentation that's required. What do you require your employees to provide you when they use the credit card? Don't just request the credit card receipt, request the documentation that details out what you purchased, because most of the credit cards just have the amount on it. You want to see exactly what makes up that amount. Approvers, of those monthly statements. Who can approve the monthly statement? You want to make sure that the detailed receipts from all the charges are reconciled to the monthly statement, and then that monthly statement is reviewed by somebody else who doesn't have access to the card. So if the town clerk or the executive director has a credit card, somebody else should be reviewing the monthly statements and the receipts. And that kind of goes into the monitoring of the card usage. Also, never allow for cash advances through the credit card. This just screams abuse. Communicate your policies and procedures and really communicate the compliance with these policies and procedures. Review of all the credit card payments. Also obtain a list of your cards, including the numbers and telephones numbers, and include all of that somewhere and keep that safe so that you always have a record of those credit cards. And then, as I mentioned, I think, what happened with Abita is that the CFO was using the card and nobody was really watching over what she was using. And then she opened, I think, another credit card that nobody really knew about. So when you review that general ledger for anything odd, that could have probably been picked up at that point in time. So for them, they had some breaks there where they didn't have some of these good controls. And as a result, they ended up in the news, which nobody really wants to be there. So that's all I have for you guys. Time for questions. And I also wanted to give out my information if anybody has other questions.
Well, thank you so much, Michelle. That was very informing and something I think that everybody needs to know about. I'll open it up now to questions. As I said before, you can either raise your hand. I think there's a button for raising your hand, or put a question in the chat, and I'll let Renee sort of moderate the questions. And I'll start off, Michelle. What do you find is the biggest issue that you're finding with audits, especially with nonprofits?
Depending on the organization, I think it's being able to account, if organizations, nonprofits receive restricted funds or restricted monies, I think recording and accounting for those restrictions properly is probably the biggest thing we'll see.
And then let me ask you also, since most board members on nonprofit corporations they're not compensated, they're volunteers. To what extent do you see engagement by those nonprofit board members?
As far as engagement within the activity
process, I mean, do they ask questions? Do they, are they? You think they're informed?
Depending on the entity, and honestly, I see this across the board with a lot of my clients where they understand the entity that they are a board member of, but I think sometimes the financing of it all kind of overwhelms them a little bit. So a lot of times what we try to do is that we'll meet with management or like a subcommittee of the board and really do deep dives into the audit report. But then when we go to the board, it's more of a high level overview of the finances. Because I think what a lot of the boards really want to know is, do I have any findings? And are my financial statements materially stated?
Would you recommend that nonprofit board members or boards have at least one person as a board member who has some sort of financial experience, whether it's an accountant or something like that?
Yes, that would be very beneficial to the board and the entity. It's not always easy to get, but it would be very beneficial.
Renee, do you see any questions popping up?
We have no questions in the chat.
Well, that must have been, you must have covered everything, Michelle.
Well, thank you guys very much. I appreciate being here with you this morning. And I'll give a copy of the presentation to Renee. So if anybody wants to take a copy of it, you can email her and you'll have my contact information there. So if you have any questions for me, you can email me.
All right. Thank you so much, Michelle, for volunteering to do this. We really appreciate it. And we will continue this training tomorrow morning at 9:30.
Thanks, guys. You have a great day.